Okay, guys, let's take a look at page 206 in your textbook. I'm going to run through a little scenario here using that textbook, but then I'm going to sort of point out a few things, so again, to give you a little bit of insight on actually what's happening. Now, you have to remember, the only time that petty cash actually interacts with the accounting records is very, very limited. Number one, it interacts with the accounting records when we actually establish the funds, which means that we actually write a check out to cash, we take it to the bank, we give the check to the teller gives us back currency, and then we take the currency and we take it back to the office and we put it into a lockbox. So that's the first time that petty cash interacts with the accounting records. The second time that petty cash interacts with the accounting records is when we actually reimburse the account. So again, we're writing a check for the amount of the receipts in the box to reimburse the box back up to what it should be. Then we're taking that check yet again back to the teller at the bank, and the teller is giving us currency in return. Then the third time that petty cash may interact with the accounting records is if we decide to increase the balance in petty cash, which means again we would write another check for the additional amount that we want to increase the balance in the lockbox by, or we actually take cash out of the box, and to reduce the balance, we would take cash out of the box, take it back to the bank, and actually deposit it into the bank, and then we would record a deposit back into our checking account. So again, those are the only times when petty cash actually interacts with the accounting system. Any other time, think of petty cash as a little bit like its own separate accounting system. So watch what happens here. We read down through the transactions that occur, and again, I'm on page 206. The first transaction that we have is we establish the petty cash fund. So you can see in this little petty cash log that we deposited $500 into the petty cash box. So again, we issued a check out of the checking account, took it to the bank, brought currency back, and put the currency in the lockbox. All right. The next item that we have is this item from Hanson's Grocery. So somebody came in with a receipt, and we gave them $30 in cash in exchange for the receipt. So watch what happens down here at the bottom. Alright, so the amount withdrawn is $30. So the receipt balance, oh, hang on a second, I need to adjust sorry about that, I had to adjust the formula in that box. So if you can see, we started out with $500 in currency. Somebody came in, we gave them $30 in currency, and they gave us $30 in receipt. So at that point in time, the box now has $470 in currency and a $30 receipt in the box for a total balance of $500. All right. Then the next time somebody comes in, we reimburse them $70 for postage. So again, they give us a $70 receipt, we give them $70 in currency. So at that point, the balance in the box is $400 in currency, $100 in receipts for a total balance of $500. All right. The next one, we've got Northwest Messenger. We reimburse somebody $25. So again, they gave us a $25 receipt. We gave them $25 in currency. All right. The next one, we've got the reimbursement from Office Depot. So somebody went and bought $175 in supplies from Office Depot. So again, they gave us $175 in receipts. We gave them $175 in currency. And then the last one, and again, notice what happened here. Currency balance is now down to $200. The receipt balance is now $300. Total balance, yet again, $500. Then the next one was a reimbursement for $63. So now there's $363 in receipts in the box and $137 in currency. So at this point in time, if we choose to reimburse the box, we would have to write a check out of the checking account. Okay, don't miss that. We would have to write a check out of the checking account. So if you look at page 206, that's that January 31st entry there. Notice that the cash is the regular cash account. It's not the petty cash account, because we've got to write a check out of the checking account for $363, which was the amount of the receipts. Take that to the bank, reimburse the box, and now we would end up with, okay, we would transfer the $363 in receipts. Okay, so now we're down to 0 in receipts, and now we're back up to $500 in currency. Okay, and then yet again we would start all over again. So then we would start reimbursing everybody for the receipts that they gave us. We would start building up a balance in the receipts, and then we would actually have a reduction in the currency balance. So again, as each one of these items is reimbursed, nothing is happening with interacting with the accounting records. Again, we only interact with the accounting records at the point where the box is reimbursed for the receipts. So the other thing that happened on page 206 was in item 3. It says, assuming the entry from requirement 2 has been made, prepare the journal entry needed to increase the fund balance to $600. So we originally had $500, we now need to up it to $600, so we write another check for $100 out of the checking account, that's our credit, and we take that check to the bank, and we get currency for it. The currency goes into the petty cash fund. Alright, so hopefully that gave you a little bit of insight on what's happening with petty cash. Let me know if you need anything else.